Another video. This video will be on a psychological topic, a little bit of a dark topic, but one that needs to be addressed, and that is the topic of gambling addiction and how it intersects specifically with interacting with the markets and trading. Now, if you have a gambling problem or a gambling addiction, you should not be interacting with the market. Period. Really, in the broad sense of the term. But even people who don't have a gambling problem can develop a gambling problem, and it's something we got to watch out for. A lot of people will say, well, I'm not a gambler, I'm a trader. Well, they're wrong. All traders are gamblers, right? We're entering in a probabilistic scenario of win or loss. The only difference between us and gamblers that you see at a casino or a horse race is those gamblers don't have an edge, right? The horse track has an edge or the casino has an edge, but they're still gamblers. They're just gamblers without an edge. Hopefully, if we're successful, profitable traders, we have an edge, but that doesn't mean we're not gamblers, right? We're gamblers with an edge. So it's very important to implement, methodologies and, what habits that guard yourself against, the possibility of falling into, what could be described as impulsive behavior, right? And it's something it's hard to watch out for because it creeps up on you and you don't necessarily know that it's happening. One way you can kind of tell that it's happening is if you feel the desire to always be in a trade, right? That's a red flag. On the flip side, right, conversely, right, anytime you exercise patience, you are taking energy out of the impulsive gambling addiction, right? The desire to act impulsively. Whenever you exercise that muscle of patience, you're casting a vote against impulsive behavior. So it's very important to exercise patience, right? And exercising patience also increases our edge, right? If we have certain criteria that determines, like, maybe our edge gives us a signal, but we don't take it because of various other contrarian signals that we've incorporated into our methodology that tell us, hey, yeah, even though my edge is flashing a signal, there are these other things that tell me, not to take the trade, right? And those are very good because not only do they increase our edge, our probability, but they also exercise the muscle of patience. So it's like killing two birds with one stone. It's a very, very important concept to incorporate into a trading methodology, especially over the long term. These are the type of things that, these are like laying the building blocks of your trading foundation, right? There will always be another trade to be taken. There will always be another setup. If you miss a setup, that sucks, but there will always be another. All you need to do is have the patience to wait for it to present itself. So, this is something that, kind of over the long term in a trading career, it's almost natural for, these impulsive habits to kind of pop up, right? A lot of times they'll creep up on you maybe in a time in your personal life where, things aren't going great, right? And the rush of trading or the rush of that, being in a profitable trade, you gravitate towards that as a way to escape from some of the unpleasant situations going on in your real life, right? So you got to be able to recognize that, shut that down. Again, it's very hard to do, but this is like, I'm making an argument for why we need very specific rules and habits that govern exactly when and how we enter a trade, right? And very rigid rule structures around what constitutes an entry. That way we don't end up entering trades, out of emotion. And that's something we can build out in our trading plan, right? We can build out, these different criteria that constitute a trade. And we can, the more you can build that out, the better off you're going to be in the long term. And, I've seen a lot of people who, have, kind of succumbed to this impulsive behavior well advanced in a trading career. People who would be considered to be professionals, people who you think are sort of enlightened, people who, you look up to, right? And the moral of the story is that, you never reach a state of enlightenment in trading. People think that that's a possibility, but it never actually happens. And the reason why it never happens is because you're always going to be a human being. You're always going to have the same psychology. You're always going to have the same hardwiring. You're always going to have the same biology. Personally, I knew a lot of people who traded at the CME group back in the 90s. And I remember hearing this one story about the biggest trader on the floor back in the 90s for the equities trading pit, the S&P 500 specifically. And he had a bad day one day and started going down the impulsive road. And this is, remember, this is one of the most profitable traders on the floor at that time. And he just, for whatever reason, he kind of snapped, and he just broke down and had one of the largest losing days ever seen in CME history on the pit. It got so bad that the firm he was working for had to come down and tie his hands behind his back so he couldn't trade anymore. Now, he obviously went home, took a little time off, resolved the issue, and, it didn't cost him his career. But if you let those type of things spiral out of control, this is how you get into a very negative scenario where, you're doubling down on losing trades. And of course, we all want to avoid that. So, creating very specific scenarios to avoid that, again, is extremely important. And just circling back, the best way to do that is to create very rigid definitions of what constitutes an entry. And by entry, I mean adding risk. Whenever you're adding risk, you need to be very specific about why you're adding risk, where you're adding risk, how you're adding risk, and when, what constitutes a situation where you need to pull that risk off, right? Those things need to be very, very clearly defined. And of course, you also want to have clearly defined situations where you don't take a trade or you exercise that patience muscle. And finally, as the third part, and this is more of money management, but you want some type of system in the way that in your money management protocol that protects you from a losing streak before you even know that a losing streak is taking place. And what do I mean by that? Well, over the course of any trading career, you'll have a string of significant losses. Now, the insidious thing is that as the better you are at trading, the more likely you are to experience an extreme string of trading losses. And by that I mean, say, 10 trading losses in a row, right? Because your sample size of trades is getting larger and larger. So, for example, if you have a sample size of 100 trades, right, the odds of you having a losing streak of 10 losing trades within that sample of 100 trades is basically zero, right? It's so unlikely that the probabilities are basically zero. But as you keep expanding that sample size, eventually that probability of having 10 losing trades in a row approaches 100% as the sample size gets bigger. So, take, for example, expand that sample size from 100 trades to 100,000 trades. Well, now when you're at 100,000 trades, the odds of having a 10 trade losing streak within there is basically 100% just because of the law of large numbers. So with that in mind, if over the course of a long trading career, we're going to have a very large sample size and we're going to experience those losing streaks, right? So we need some type of money management protocol to protect us from those losing streaks before we even know they're occurring, because those losing streaks can then break us psychologically, start to doubt ourselves, start to make us act impulsively. And a money management protocol can be sort of a shield to that happening. And one way to do that is to basically, after each consecutive loss, after a certain amount of losses, you lower the risk on each entry, right? So for me personally, that's, after 3 trades, I strike out, I start reducing risk on each subsequent trade after 3 trades until my account equity reaches the beginning of that reduction in risk. But, it doesn't have to be 3, it can be, a different number. That's really a personal thing. But the point is, after a certain number of losing trades, and it should be a few, right? Maybe it's even 1. Maybe you lose 1 trade and you reduce risk. Maybe it's 2, 3, 4, whatever. But the idea is that by the time you're at your 5th losing trade, the risk you're taking on that 5th entry needs to be significantly lower than the risk you took on the first entry. And when you do that, because you may not realize you're in a losing streak until that 5th trade. And then if you keep losing, if it continues after that point, then that's where things really can spiral out of control. Again, just any type of rigid parameters that you can create around your trading methodology is going to benefit you greatly. And I'll end on this note. Basically, one of the things that entices us into trading is the ability for us to express ourselves creatively in an unlimited amount of possibilities, right? There's an unlimited amount of ways we can interact with the market, but nobody can intervene to tell us otherwise, right? It's us interfacing with the market with an unlimited amount of possibilities. But, over the course of your trading development, you realize that in order to be a profitable trader, you have to severely limit those interactions into a very narrow window with the market. And we have to apply a very rigid, structured rule set to the way we behave when we're interacting with the market. So the journey to being a profitable trader is directly contrary to some of the underlying subconscious motivations that got us to pursue trading in the first place. One way to kind of resolve this issue is to make sure that you have some way to express yourself creatively in other areas of life, right? You can't afford to express yourself that way creatively in the market. You'll lose your everything. You really can lose everything. But if you're maybe whatever it is, right? Just some form of creative expression, artistic behavior in other avenues of your life, so that when you approach trading, you can approach it with the disciplined warrior mindset that you need to be successful. Anyway, I hope you guys like this video.